From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, inflation continues to cool down, but Fed speakers say they're staying the course as bond issuance comes back in a big way. We begin with the big issue, a bumpy landing ahead.
Personal consumption expenditures core today.
We don't have a clear vision of what's going ahead of us.
It all comes down to the labor market.
The Fed's ability to tolerate unemployment.
The Fed is not thinking pause right now.
Inflation is obviously well above their objective.
They're hawkish on inflation.
If they pause, what does the market do in response to that?
The market's pricing in, give or take 100 basis points, of rate cuts by the end of the year.
This is a very sticky, tricky environment here.
We're about to get the full impact.
A moderate recession?
Recession is inevitable.
Joining us now, Collin Martin of Charles Schwab, Kelsey Berro of JPMorgan, and Vishy Tirupattur of Morgan Stanley. And Vishy, I want to start with you. Is it that black and white? Is a recession truly inevitable at this point?
I think it's not as black and white. I think the probability of recession has certainly risen, but it is very difficult to say pinpoint and say a recession is happening imminently. It might. We don't have a good sense of how the tighter financial conditions and the tighter lending credit conditions that will come out of what we expect to come out, how quickly and how they will play out. I think it is safe to say that the prospects for growth have certainly dimmed further. The deceleration of growth that we have been seeing, it probably continues. The pace of that deceleration picks up, and the chances of a hard landing have certainly risen. The timing of which is yet unclear.
Well, actually, on that point, we caught up with Matthew Lazzetti of Deutsche Bank earlier today on Bloomberg Surveillance, and he said that tighter credit could lead to a landing that some won't anticipate. Let's take a listen.
We do think that credit conditions are going to tighten. The way that we've tried to quantify it suggests it could be anywhere from 0.5% on growth to certainly more than 1%. But at this point, it's difficult to gauge. If that does tighten, I think it certainly means hard landing is more likely than even we were anticipating.
And Collin, it's a bit of an impossible question, but if you had to quantify it, how much is what we're seeing in the banking sector worth in terms of Fed tightening?
We think it's worth something. So I don't know if I'm going to give you an exact number, but we do think that it can replace part of the Fed rate hikes, as Fed Chair Powell alluded to. This is probably the number one thing we're looking at. It's something that everyone's talking about. Obviously, you just showed that clip, but tightening credit standards, tightening credit conditions. One thing we've been looking at a lot lately is, of course, the senior loan officer survey. We saw tighter conditions pretty much across the board in terms of tighter standards, lending to companies, higher spreads, and then we've also seen lower demand. So any way you slice it, I mean, that slows down or should slow down economic growth. But most importantly, those numbers were mostly from the fourth quarter of last year. So given everything that's going on now, it's tough to see banks really looking to take too much risk. They have that whole unrealized loss situation that they have to take care of on their balance sheets. It doesn't seem too likely that they're looking to take much credit risk right now. So we expect this to really play an important role. And we talk often about long and variable lags with monetary policy. We think we're starting to see them, and we think we'll continue to see them as credit standards continue to tighten.
And Kelsey, when you were last on the show on March 3rd, you and I were debating whether or not the Fed was going to go 50 basis points at this month's meeting. And now the question has become whether they hike at all in May. And given the backdrop, given the conversation that we're having, where do you think this Federal Reserve goes from here?
You're right, Katie. It's amazing how much a month changes things. And, at the time, we were arguing for 25. We were telling them, or our view was that those cumulative and lagged impacts of monetary policy were going to start to bite. And as the other guests mentioned, the Senior Loan Officer Opinion Survey was pointing to recession before the last, the dust up with SVB and Signature Bank and Credit Suisse and UBS. So from here, we really only expect further tightening of credit conditions. One of the things that we've been digging into is looking at the loan growth in the post-pandemic recovery. It's been disproportionately driven by the small and regional banks. So if those small and regional banks start pulling back on their lending, we don't expect the large banks to pick up that slack. And so ultimately, it is going to result in slower growth and lower inflation, and it is going to allow the Fed to pause. So if I look at the core PCE data today, this in fact is the first month of the tightening cycle where the Fed funds rate is above the rate of core PCE inflation. So I know everyone is focused on core inflation being sticky high right now, but we're seeing both our bottom up and our top down indicators really pointing to a deceleration in inflation coming over the next few months.
Kelsey, it's a good point that the Fed did get at least one win this morning when we got those PCE numbers coming in a little bit softer than expected. But of course, we know that the consistent message from the Fed has been that they need to do more work. And we heard from Boston Fed President, Susan Collin. She caught up with Mike McKee this morning, saying that the recent data has not swayed her outlook.
My assessment at the last meeting, just last week, with the summary of economic projections did suggest an additional rate hike and then pausing and holding over the year. But I need to assess all of the data that's going to come in between now and when our next meeting is in early May. The new data that I've seen just in the past week has not materially changed how I'm thinking about things.
So, Vishy, definitely sticking to the script there. But what does more work to do mean for this Fed? Does that mean simply hiking rates more or just not cutting?
I think I think she herself said that there's data to be coming, and they'll be watching the data. We have all of April data to come in, and I think our own expectation is they will hike another 25 basis points. That's our base case expectation, and then pause at that level. That's what our economists are saying at this point. But we are keenly aware of if we have depending on how the data pans out between now and May 3rd, we are keeping our minds open.
All right, an open mind. I like to hear it. But if we look at what the bond market is pricing in, Collin, I see more than 50 basis points of cuts priced in at this moment. Again, the Fed has made very clear from the top down that cuts are not in their base case. But what would need to happen in the economy for those cuts that are priced in to actually become a reality?
Well, I think we'd need to see the banking concerns likely, not necessarily spread, but just stay out there for a bit. They've kind of taken a backseat given all the Fed speak lately, given this morning's slightly better than expected inflation report. We'd likely need to see them remain a concern. We'd likely need to see inflation continue to slow, and then probably more economic data just tilting towards the negative side. I mean, right now, the markets still aren't buying what the Fed is selling. Like you alluded to before, most officials are kind of towing the same line and saying we expect more work to be done, but the markets are only pricing in a 50% chance of a hike at the next meeting. A lot can change in the next 4 to 5 weeks. So we're going to be looking at that a lot. As the other panelists said, there's a lot of data that's going to continue to come out. For those cuts to be a reality, to become a reality, we'll need to see a significant turn for the worse in economic data and a continue in the disinflationary trend.
Collin, what's your base case?
For the Fed coming up, we do expect them to hike at the May meeting. We don't necessarily agree with that because we think the cumulative impact of all the Fed tightening, as well as the tighter bank credit standards, we think that is enough. But we are listening to officials. They're telling us what they intend to do. They're telling us that the banking system seems sound right now and that they are committed to fighting inflation. So they didn't ask for our opinion. We do think they'll hike in May, but we think it'll be a hike and then hold to kind of see how it plays out after that.
And Kelsey, it's the last trading day of the month, finally, and it's worth reflecting on what an insane month of volatility it's been. If you look at two-year Treasury yields, we were above 5% at one point. Now we're hovering around 4% or so. You go out the curve, you look at 10-year yields. We were above 4% earlier this month. Now we're hovering around 350. When you think about the charts, the dramatic moves that we've seen, have we overshot to the downside when it comes to yields?
So maybe in the short term, we may have overshot. I mean, there's been a lot of rate volatility, as you mentioned, but we do think in the longer term, the direction for yields is going to be to continue to move lower from here. So we actually view a two-year yield above 4% ultimately to be probably a pretty good buy. You know, will yields move up maybe another 25 basis points on a retracement? Yes, that's absolutely possible. But the way that we're thinking about investing right now is to be extending duration of our portfolios. We get this comment a lot, that cash at 5% is really attractive. Well, if you think cash at 5% is attractive, you should also think that the two-year yield above 4% is attractive, because 5% annualized rate, you only get that if cash rates stay at 5% for 12 months. In our view, we expect the Fed to cut in the fourth quarter of this year, and so you're better off locking in those yields, but also being able to extend duration and take advantage of the potential capital gains as yields move lower.
Vishy, weigh in here. Where do you fall on the duration debate?
I think at the moment we are still neutral on duration. I think well, you know, we'll need to see, you know, some range of this. We've gone through a period, as you noted earlier, Katie. We have seen a enormous volatility in the front end, the two-year part of the curve. We need to see some stability before we feel comfortable enough recommending duration. We are not quite there yet.
And the thing that I always get tripped up on in this conversation, basically whether or not it makes sense to go out the curve here to extend duration, is why would I? Like we've just been talking about, you can get very, very high yields at the front end of the curve. Collin, when you're talking to clients about the case for duration or where along the curve you want to be, where do you fall?
I'd echo most of the points that Kelsey made. It's the number one question we get, and what we focus on the most is reinvestment risk. And most of our clients don't want to hear that. It's something we've been talking about for a while now, and I think it's an even more difficult pill to swallow when you see the 10-year yield at just 3.5%, knowing that you could have got 4% or more just a few months ago. But we think the risk is that at some point the Fed will cut rates. We don't think it's going to happen necessarily soon. The Fed has told us that they want to hike and hold, but at some point that rate is likely to come down. So considering a 5-year, a 7-year, a 10-year, whatever makes the most sense for you as an investor, we'd move a little bit further out and invest and lock in that yield with certainty rather than being at the whim of what the Federal Reserve needs to do down the road. So that's been our case for a while. Again, it's a difficult pill to swallow, but we'd rather lock in a 3.5% to 4% yield for the next 5 to 10 years rather than risk being at, you know, say 2% or maybe even lower at some point in the next year or so when the Fed does need to cut.
Collin Martin, Kelsey Berro, and Vishy Tirupattur, everyone is sticking with us. And up next, it's the auction block. As bank uncertainty settles down just a little bit, firms drive back to the bond market to sell debt before earnings season. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we finally saw a ramp up in bond sales after they stalled amid the banking uncertainty. Europe saw 33 billion euros worth of issuance this week. The U.S. also had a rush of borrowers to end the quarter, but both regions still fell well short of projections for March. Looking at the quarter overall, that stall in mid-month put a damper on global corporate and financial sales, sending them both to the lowest level since 2019. Meanwhile, the freeze in the U.S. junk bond market is showing signs of thawing, with a packaging company marking the first deal since early March. Meanwhile, Amanda Lynham of BlackRock says that the sharks are circling in the credit market.
we're already seeing some signs under the surface of levels of distress picking up in the credit market. So if you leave the default rate aside, which is fairly backward looking, but instead look at real-time valuations, what we're seeing is that the share of bonds in both the US and European high-yield fixed income markets trading at distressed levels or above 1,000 basis points has picked up to levels that we haven't seen in the US since the summer of 2020. So the market is signaling that there is some concern.
Still with us, we have Collin Martin of Charles Schwab, Kelsey Berro of JPMorgan, and Vishy Tirupattur of Morgan Stanley. And Kelsey, sure, if you look under the surface, there are signs of stress in the corporate bond market. But if you look at overall investment grade and blue chip spreads, I don't see anything close to panic levels. IG currently around 140. You look at high yield, it's 470 basis points. Does that make sense?
Well, it may make sense for the short term. The Fed and the FDIC have taken bold steps to provide liquidity to the financial market, to the banking system, and that has allowed investors to be able to pause and take a breath. And actually, this is a great opportunity for us in our portfolios for what we call spring cleaning. So essentially, we are stress testing all of our portfolios, all of our securities, all of our corporates, all of our securitized credit against adverse scenarios. And we're cleansing the ones that don't stand up to the test. And this relative period of strength is going to give us the opportunity to do that.
Spring cleaning, it's a useful exercise in really all areas of life. And when you're, dusting off the portfolio, when you're taking out some of those less good-looking credits, do they tend to fall in any specific sector, or how are you evaluating these?
So we do think that there are a variety of areas that we're focused on right now. We are focused on core, high-quality fixed income. Within the investment grade, the stress has been very concentrated in the regional banking sector, but there are a variety of high-quality industrial and non-cyclical names that have prepared their balance sheets appropriately for upcoming strength. Outside of the investment grade market, another bucket within our core high quality fixed income portfolio alongside treasuries and investment grade would be agency mortgage-backed securities. So these are fully guaranteed by the government. They tend to trade with a little bit more volatility when there is excess rate volatility, but at the same time, they give you an extra 70 to 100 to 150 basis points of yield pickup, depending on where on the coupon stack. And that's another area that we're adding to the portfolios to build that high quality core portfolio to weather potential storms.
And Vishy, come on into the conversation. When you're looking across the corporate credit market at this moment, where are you seeing opportunity and what areas are you avoiding?
Actually, I quite agree with what Kelsey said. Our recommendation remains looking for high quality fixed income, high quality investment grade, perhaps away from some of the regional financials, regional banking sector, where there is probably going to be more supply to come. Our expectation is that banks, particularly regional banks, will play defense, and defense is the new form of offense for these banks. And the coming as part of that defense would be, shore up more liquidity, more raised, tap the wholesale funding markets. So perhaps more supply to come. We've seen this. So there's potentially in some of those parts we'll see more supply pressures. Maybe that's where what we were suggesting is looking at away from them, in high quality industrials, overall investment grade market, and very much supportive of the agency MBS. We think the agency MBS market is one market where it's significantly additive to the to the overall returns, and that's something we are very constructive on.
Well, guys, to this point on what we're talking about when it comes to banks and regional banks, never let a good crisis go to waste. That is a true statement in journalism and in portfolio management. You do have some investors trying to sort through the rubble here. And we have a quote from Sam Wilson. He is a portfolio manager at Voya. He said to Bloomberg News that if you are willing to buy into the fear, there is definitely an opportunity. There is still room for spreads to heal when it comes to some of this bank debt. And Collin, when you're evaluating the risk return of some of these bank bonds, what do you see? Is the reward greater than the risk?
I don't think so right now, although I'll hedge that a little bit. If we look at the financial market specifically, we think most large financial institutions with investment grade ratings are in okay shape, and the Fed facilities that are in place now should help shore up liquidity concerns. And when you take all that into consideration, we're generally okay with them. We tend to take kind of a big picture look at the corporate bond market. We allow our clients to then decide what's in their best interest to invest. My comments are going to echo the other two guests. So I don't have too much in terms of an alternative view here. But we're really excited about investment-grade corporate bonds right now. We were talking earlier before the break about extending duration and maybe some clients and investors pushing back on moving further out in the curve or being disappointed with the drop in yields. Mm-hmm. If you look at investment-grade rated corporate bonds, on average, you can get 5% or more almost all across the curve.
Right.
We think that's really attractive depending on interest rate risk and without taking too much credit risk. So we think if you're an investor looking for higher yields, they're still here.
All right, Collin, Kelsey, Vishy, everyone is sticking with us. This is Bloomberg Real Yield. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, St. Louis Fed President Jim Bullard sits down with Bloomberg's Mike McKee on Monday. And then Tuesday brings even more Fed speak, plus Credit Suisse's annual general meeting post-UBS takeover. Thursday brings another round of U.S. jobless claims before the main event on Friday, of course. That's the March jobs report. Before we get there, though, it's time now for the rapid fire round. 3 questions, 3 quick answers. Vishy, I want to start with you. Do 10-year Treasury yields touch 3% or 4% first?
3%.
Kelsey?
3%.
Collin?
3%.
Vishy, does the Fed hike in May?
Yes.
Kelsey?
No.
Collin?
Yes.
All right, guys, final question. Vishy, does quantitative tightening last through the end of 2023?
Unclear.
Kelsey?
Probably not.
Okay, probably not. Kelsey, your view?
No.
Collin?
No.
All right, let's leave it there. My many thanks to Collin Martin of Charles Schwab, Kelsey Berro of JPMorgan, and Vishy Tirupattur of Morgan Stanley. Great discussion, guys. Really appreciate it. And as we close out the final trading day of the week, the final trading day of the quarter, you look at where 2-year Treasury yields are right now, 4.09%. The high for this month, as you know, it was above 5%, and that feels a long time ago. You look at benchmark 10-year Treasury yields. Currently, they're at 3.50. That number is like a magnet. But again, remember, earlier this month, we were above 4%. Again, feels like a long time ago. We know that that banking crisis left a mark. A quick check on the S&P 500 right now, up 0.9%. Stocks continue to rally. From New York, that does it from us. We will see you in 2 weeks after a break. This was Bloomberg Real Yield, and this is Bloomberg.